Good morning, Rocket Scooter. It's great to do this. Opening DD bands break S&P and Nasdaq. A rational day. Maybe I should just take off and go to the beach, go to the museum, find something to do, get a hobby. I'm probably gonna make any trades today. Love waking up and know exactly what I'm gonna do. We'll see. We'll see what happens. Welcome to the stream, everybody. Welcome to the stream. Hit that like button. It's great to get started. Irrational open. Ooh, 30 minutes for market opens. Already no problem. I could do anything. Love it. what's up? Good morning, guys. Okay. Sorry, I was just pre-market wrapping, chit-chatting. Oh, is there no sound? Oh. Okay. Good morning. So what's going on? Markets are rational. I'm already sitting out. I'm getting my doomsday bands here. Yeah, I was chit-chatting for a second. Pre-market starts in about 5 minutes, but let's get our DD bands on the chart. I'll explain to you what's going on. A very predictable day today. And actually the response we were seeing is predictable as well. I'll talk about what's going on in the market. We are experiencing a catalyst. Clearly, we're going to go straight to, let me do these bands really quick. High SPY 472. We have a release coming out. The platform, I just tested on a live server. Guess what? Save screen layouts on multiple monitors. Done. Tested it out last night. 2 in the morning. Woke up. Here's the patch. It's coming out. I'll give you guys a little bit of a nice thing. I don't know if he's going to push it tonight. I might make him wait till the weekend just so we don't crash the servers for tomorrow. You know, Rocket Studio does have about 600 new users in the last 9 days. It's insane. We had to upgrade servers all across the board just to handle all of you new folks. Like literally, they're going beer runs every 5 minutes. Y'all drink all the beer. It's a good problem to have. Party is getting huge. All right. So I had a vote and told them that I didn't want to push anything live this first week until we got everybody onboarded. Nobody's first experience when you buy your iPhone, you know, 17 or 20 or whatever iPhone is out, and you go home and open the box and the phone isn't there, you can be kind of a, you know, an unhappy camper. So we might not push. I might make him push it live Friday night. Here are the releases that are coming out. We've renamed hedge dist up, hedge dist down, which you know is the distance between hedge pressure, to hedge spread. Makes more sense for people selling spreads and stuff like that. Plus hedge dist, distance to hedge, distance to monthly. It's confusing that these two looked similar, so people didn't intuitively know the difference. But hedge spread is the distance between the two. Just a rename change. We're gonna have wall target up and wall target down parameters. Finally, in liquidity pocket, illiquidity pocket, you will know how much percent until that next wall, as you will have in the parameters column. If you're searching for illiquidity pocket and next wall target, it's like saying at 414.5, it will tell you that 416 is the next target. The percent distance run you have on that run. You can now rank and sort your illiquidity pocket searches, those of you in the class yesterday, by how far that next resistance is. You can now have a trade plan and sort by the reward side of your trade plan. James P, go to the first week training. We've reorganized everything. You all catch up. There are videos. We're doing new video series for 6 entire weeks, every day, new training videos. We're remaking everything. I encourage you to go through, especially if you're new here, everybody go through the series. Do not just jump in. I promise. There's a reason people come here and stay here and like what we do. It's because of how we train. Do not skip. That's the best part. Sit here in the stream with me. We're going to shoot the shit and have fun. We're going to learn about some markets. I'm going to tell you why I'm going to sit out today, and I already know I don't make any trades. But I encourage all of you to go through the training and go through it live if you can. If you've been through the training or you're going through the training right now, it's your first time through the training, especially Ashton's folks. It's your first time experiencing this knucklehead Matt. Why don't you tell some of the people that just joined today, this is day 4 of the program, your genuine experience. Like what, like if they just walked up and you all walked out of class, right? Tell them what you think about it. Because their first inclination is like, oh, I got to catch up on some videos. They're clearly going to be lazy and not do it, right? So what do you say to that? Lazy folks, James P. brand new. I'm gonna show you where it is, especially. Let's make sure everybody gets in here real quick. I need to tell people to stop messaging me and start messaging Slacks though, because I am live. Okay, Slacks, I don't think he's here right now. He's probably still like, I will get you though. Okay. What's going on in the market? We'll talk about this. This is very predictable. It's wave 2 of inflation. We predicted wave 1 would turn around over a year ago. We predicted kind of when it would happen. We talked about what the mechanisms of war and how it would repair. And we're now entering that second phase of inflation that we predicted as well, a second smaller wave of increases, and the market's responding very negatively to that on 2 fronts. I'll explain to you why that is after we get started. We got a lot of room to cover. Just to kind of teach you a little bit of the fundamental stuff. Y'all will love it, I promise. Promise. This is very, very predictable what we're experiencing. Okay. Yeah. Please watch in order. The lessons are built the way the fundamentals are built up, and one lesson will lead into the next by category and make more sense if you follow in order. That was the whole point, was to create a linear thing where it was like you kind of circle back and circle back and circle back so that everybody remembers and learns. Okay, just for a fun event, those of you that are just new to the stream, read what these folks are saying. Bonnie Texas, take the training. Sure, you can fumble your way through, but you won't truly understand nuanced information. Did y'all like the liquidity pocket? Somebody told me that liquidity pocket was the most mind-blowing thing they've ever heard about the market. And I didn't even think too much about it. I know it's a cool thing to learn, but they were like, it was just one thing after the other. And like, I never could have guessed any of this. And it was really cool feedback. And another person said something in chat and inspired me to go back and watch it. So I actually laid in bed, waiting for my 2 o'clock in the morning meeting with my team to review and the new release of the platform. I was watching my own video. I never watch my own videos, actually, unless I'm editing them. I had some pretty cool, I guess, stories I told in that one. Pretty dope. Okay. All right, guys, smash that like button if you can really quick. We'll talk about the modes of inflation. Let me get everybody in here. Kind of waiting on folks to get into the group. I've been adding all morning. Okay, just FYI, if you guys know me, like I said, we have a whole bunch of people. So make sure everybody has this. Okay, I'm just messaging everybody that signed up yesterday. All right, let's get everybody here. All right. Members. Okay, so we're already opening with the rules saying, for me, 100% right. The rules are irrational at the open. I'm literally sitting out. So we're going to have fun. I'm going to show you some platform features, and maybe we'll show some new platform features. That might be pretty fun. And we'll go straight into the lessons earlier than normal. I like that. Okay. How do you... Oh, here it is. Get you in here. You're good. You're good. I really need to write this bot that integrates my Discord with Stripe. This new feature I want to do to automatically do everybody's roles. All right. Sorry, I'm not talking. It's taking me a little bit to get everybody their roles. We manually do it one at a time at this point because we never made that thing. Okay. Welcome to the stream, friends. Welcome. We're about to launch into orbit. The orbit of sitting out and taking names and just chilling. Oh, thanks. A lot of these somebody's just like, Matt, you're muted. Quit talking to yourself. Like, oh, okay. Oops. Gotcha. Gotcha, buddy. Last person, I'm done. Okay. 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 All right, it's everybody. Okay, good. That'll cover everybody for now. All right, ready to talk about inflation? Let's go. Everybody smash that like button really quick. Click it. Give the algo some love. All right. Irrational out the door. Let's go ahead and mark up. This is from the bot in Discord. You guys remember? Now, just know when you convert something that's futures, the DD band is futures, right? This is the rule. I will talk you through it and I'll walk you through it. When you convert something that's futures to equities, right? The bot right now holds us over till it's automated in Discord. I mean, sorry, the bot is in Discord, so it's automated in Rocket Scooter. So this is our bot, our Astrobot. Yeah, cute, right? Like astronaut, Astrobot. Well, it gives you information on how to get into the... You might have woken up and seen that all your Discord channels are gone. Yeah, we just kind of did a rug pull on the free trial. We just yanked it. So if you were in the free trial, your access has been terminated from the free trial because we ended it. We've been announcing it all week. Free trial's going away. And 7 days is just not enough to do anything, to be honest. It's a 6-week training program that we have. We recommend you go through all of it. We've dropped the price from $199 to $35 for 3 months. You can literally go through our entire program for 3 whole months for $105. No obligation, quit after the first month, whatever, try it out. It's now an extended trial. We want everybody to come in and go through the videos, not just grab the platform and be lost and not know what to do. The videos are magic. It's like walking into Narnia. You will go in there and have this entire world you've never seen before. And it's not like technical analysis class. It's not going to be a class on moving averages and Elliott waves and Fibonacci's. It's literally going to be 6 weeks of training and shaping you as a human, as a trader, in ways you never thought possible, and teaching you things you never thought existed. Tons of stuff. Yesterday, we showed people how market makers drive everybody to the max net loss in the market, and otherwise known as liquidity. And that was a huge eye-opening moment for a lot of people. It was like brain explosions in chat. Every day we're going over something new. Today, what we're covering is even better. So it's like brain explosion number 2. And so go through the courses. If you need access, follow these rules. Bear with us as we have, like I said, 600 new users in the last 8-9 days since the Mad video came out, and since we merged with Ashton. So we're getting everybody one at a time. In the meantime, first day training, I'm going to show you how it's been reorganized, right? This is the curriculum. First week training, it's also been reorganized. 2 through 6, it's the old program, not the new one. The new one is Ashton and I together building stuff. This is going to tell you what you're learning and why. These are the videos. Day 1 from Monday, day 2 from Tuesday, day 3 from Wednesday, and then infographics to go with the training. Day 4 is today. So if you're just getting in, you don't have much to catch up on. You have the week to catch up on it, the weekend. And it's going to be organized like this, just linear down to the bottom. So we've covered a lot of these topics. So those of you that have been in the classes, is a fun little icebreaker. We're opening irrational, aren't we? And I'll talk about the bands and what this works. This was yesterday. So what do the trainings say about irrational, and what the first 3 months we say is a good idea? If you're learning our stuff, what do you do in the first 3 months when irrational? Just kind of type it in chat as a little icebreaker. And get us started. And I'll let you know how to mark them up. So the bot here, every morning I manually run the bot just to make it easy on myself. And the futures bands are calculated in futures. This is the DD numbers. These are the DD numbers, sorry. I convert them to SPY and other ETFs just to give myself a quick guide, but you have to remember, SPY and S&P futures, or IWM and Russell futures, are never perfectly on top of each other. They stretch and compress in real time. Oh, the market's open. Well, irrational, so nothing to do. So when you convert to these ETFs, it's only valid for that exact moment in time. They actually update in real time. If you're drawing DD bands on SPY converted from a static futures, the static futures is a band that sits still, but the ones in SPY are going to dance around in real time. They're going to move like this. They're never going to be this because the two deviate. So as an estimate at that moment in time, just to give me some guidance, I just come here and put it, and they're not going to be exact. Every morning somebody says something about that, and it's part of something we have to train you on. So just as a kind of rule of thumb, this is about 307 and some change. We're way outside the bands, and everybody's saying, stand down, sit out, don't trade, just watch, be comfortable with just waiting and not really caring. So today, not really caring. Let's talk about what actually happened and why we tanked. Do you have a good idea why we tanked today? 307, and this is about 312.50. Yeah, so let's talk about that, right? Little side note, we started having some fun responses as we got close to the triple B number in VIX. This is something you haven't covered, but we've said before. Anything above here is that unusual, very volatile, overshooting pivots kind of region. I'd like to see us in VIX futures. This is VIX, by the way. In contango, and then below this white line. This white line will be there all month, 1975. Being above here, the market's just extra sensitive, right? It just went through a breakup. Don't hurt its feelings, right? It's sitting there watching reruns of How I Met Your Mother, crying, just trying to get through the days until the hurt goes away. And it's not really that easy to have the market stabilize, and very rapid and sensitive to news. That's what Triple B says, and there's an example of that, right? Every eyes. Plus, today and tomorrow are the lead off into monthly expiration, which is Friday. Markets also are usually a little bit extra sensitive on this day as well. Okay. Let's see what we got. Okay, I'm going to leave my stream here instead of hitting refresh because I want him to come see it live. Okay, I'm John. You're here. Okay, cool. Just observe really quick. So this is what right now what we're doing is a little debottlenecking of some server stuff. So if you see right here, I didn't do anything, and all the data is coming through. We're getting all the data on this side. The S&P stuff is coming through, and liquidity map letters popped up, but we have that. I have to refresh. And it pops up. So that's the thing we're gonna change. Yes, if you go back in the bands, you become rational again. We play this game called red light, green light, yellow light. Back inside the bands, it's yellow light. So inside the bands, it's a 307 long to the bear zone, and I'm out on QQQ, right? Monthly hedge resilience is positive. That's a decent scalp on QQQ to run up. We have resilience is negative, right? If you look, we are irrational anyway, so we don't assume that resilience leads the market. So in reality, the only thing that is useful are the liquidity maps, and it's irrational. So irrational markets are one of the things to learn about Rocket Scooter, right? If you have seen my P&L, if you've been watching the live challenge, this is day 16, right? I haven't lost a trading day yet on the challenge. And you might say, oh, okay, can I see those results? Absolutely. You may have noticed, and I know there's a lot of people out there, especially, you know, in the futures world, it's very plentiful. There's a reason why, I guess, Wolf Financial made this post on Twitter. It was like, who's your favorite futures trader? All right. And all I see looking on the woodworks is like, there is no close second. We love watching Matt. And the other Matt, too, by the way. We love Trades and Matt. Matt is my favorite Trades and Matt's my favorite future streamer, by the way. But people are saying, like, we love, you know, watching Church Price because he's the only person that shows the historic broker statement and literally will show you every step of the way, show you the stats of the account. What's his win rate? What's his drawdown? What's his expectancy? And every day this is updated since the challenge started. So I've committed to showing a year-long broker statement as I grow this account to $100,000 from 10. And it's just a small account challenge. This is day 16 of the challenge, and I have not lost a single day. I've not had a red day yet. I've had some red trades. I came close to a red day, but I ended up turning that to a win. And of course, we're still going. So this is to demonstrate the principles of growing an account. Market's irrational, right? What you learn in Rocket Scooter was that I train on being picky as a trader. And in our classes, you will learn how to be picky. In irrational markets, you might say, ooh, man, that's moved really far. I'm missing out. Maybe I could short this, make it long this. But in reality, if you were up 40% in your account in like 2 weeks, do you feel like you're missing out of anything? Give me some like nods in chat if you think I feel like I'm missing out on anything. I'm smiling ear to ear, baby. I couldn't be happier with an 80% win rate over the 3 weeks I've been in this. Gonna be happier with 40% in the account I didn't have before. I couldn't be happier knowing that the minute I woke up, the first thing I said is, cool, let's just chat today and have some fun. So not only did I just get lucky and YOLO some minis to get there, some micros to get there, I just have to remind you. Now again, my results are atypical. So don't think like, oh, let me buy this dude's program, that'll be me. It's not how it works. We train you and learn. But out of 147 trades I made, each one of them was meticulously chosen through a process, and the rules are the same every time. It's not that hard for me because I do it the same way every day. And when irrational, I bet small. Now let's look at the liquidity map because you could still use it to see where buyers and sellers will be, but you just have to take it with a grain of salt. So BRSU right here, BRSU. You see this? So I'm expecting the market, we're in territory 1. So if I hit yellow, I'd be willing to short back to the open. This is trade plan number 1. So right here at SPY, as long as this yellow line is enough below 0 and this trades up to 410, it is a short off of 410 today. And I can decide if I want to take it or not. And it's a small play. as in my equation has me trading about 15 or so micros, I might just put 2 on the table if I want to. But even so, I don't feel like gambling today. Let's learn something. If we go up into the bands, it is rational, yes. But when I'm irrational and then go to rational, we call it yellow light. Like for instance, green light, red light. We kind of go back to Sesame Street and you use colors to explain stuff so it's easier to remember. We use like a stoplight reference because the alerts that are coming out of rocket scooter will be a stoplight. So green light means go, means good. Rational means I can use rationalization. Liquidity map's going to show me where buyers and sellers will be. Stocks will lead the index. The resilience is a great leading indicator, and DD is just a great show of the bull market. Other than that, when irrational, it's red light. It's stop. Like, don't rationalize. And if you pop back in, it's yellow light, which means, okay, the market's every couple of minutes you hit a patch of ice and you'll slide in your car. Just be careful. So if I could trade 15 micros, if we pop back in the bands, I'm trading 2. Literally pennies on the table. That way, if it goes crazy, I don't lose anything. It's all about controlling your drawdown. If you want to grow your account, you want to learn how to grow an account. If you were here for my last challenge, if you were here for the last YouTube challenge we did, you might say Matt's on a 16-day no losing days. Does anybody remember the number? Because there's so many new folks here. The last YouTube challenge I did, which again was live with the full broker statement posted, not a single day missed. How many days out the door from day 1 was that streak? Well, I didn't lose a day for how many trading days? You remember anybody? Because I want the new folks to know exercising control is what I do and what we design Rocket Scooter to do. It's like 70 days, 70, right? Longer than your long deep, bro, Uncle Eric. That's long for show. So the point was, I was so picky for 3.5 months, it became like this hype thing where people started coming in like, okay, like you're gonna lose, just coming in to troll, just to throw a wrench in it, right? Yeah, I had some person stalk me in my community out of it, and they were just mad that they weren't getting any traction on YouTube because we were just having everybody come over and watch us, and people were just like so like mean about it. You're gonna fail, you're gonna lose, and I loved it. It was so great. We exploded in popularity, and it's like funny is that when you really trade, what I love about when you really trade, doesn't matter people say good stuff or bad stuff, because everyone wants to come over and see a train wreck, and when they come over and see a broker statement, that person literally funneled half their clients to us, and then they hated us even more. So it was kind of like when you really trade, there's just you're just invincible to trolling, and it's funny how you can just navigate through that world. But I did, and it was fun. And for 70 days, I got to see, just everybody coming here like, what the hell's going on? And it was crazy because like it started getting harder and harder and harder, and it started getting in my head after that long. 3.5 months. It was crazy. Doesn't mean you'll be that way. Doesn't mean you'll get close to that. Doesn't mean I'll ever do that again. It's just the nature of the market. And I was very picky, like today, very picky. Not gambling, nothing. Okay, ready? Ready for this? Let's go through what happened today. Now I'm going to teach you a quickie little tutorial about why the market is moving. Some Fed chit chat, right? An hour ago, we got the Fed talking. Meister, a lot of Fed speakers. Volmageddon. I didn't read that. What's going on there? In February 2018, zero DTE options creating the next Volmageddon. Well, what's in the news now, I mean, about it? They talking about how the zero DTEs are going to create a volatility dark spot. Yeah, I was on a podcast talking about this. Well, actually, let's talk about it really quick. Not the zero DTEs just now, but so We were on a podcast. I got invited to speak about this, about the inflation. And so, you know, the type of inflation we experienced after COVID is called cost push inflation, right? So what happened is you had a shortage of stuff, shortage of workers, shortage of materials, and that jacks the price of the labor and the materials. And the price of stuff goes up, and that created the first wave of non-core inflation. And now, so when you see like core, for instance, you'll see that you have, like today we had core PPI. Core excludes food and energy, which are the things that people need, right? So we call those, instead of discretionary staples, right? You need food and energy to live. These are things people will buy no matter what the price. And also, in a way, these things become currencies because humans need them. Energy, in certain parts of the world, the price of oil is the price and value of that currency. And in some communities, even locally, in a tribal sense, food is a currency. If you're a farming community, you exchange food with other farming communities, like back in the Middle Ages, right? Food is a currency. Things that people need gets you things that you need. And so when you exclude those, you're looking purely at discretionary items, things that people don't have to have, but what will buy if they have extra money. And that's what the core is measuring, is like people's desire to spend their free money on stuff that they don't need to live. You may think you need an iPhone to live. You don't. If your cost or the perspective of the seller, right? If according to you, that number month over month is going up, then you're experiencing inflation in some places. Okay, so that's a big deal, and that's the second wave of inflation. As a matter of fact, last year, when the non-core CPI peaked right about 10% year over year, it started coming down. I was on a space on the street, if you guys know that company. I did a podcast with, actually Ashton was on that one as well. Jay Woods, Sarge, and Peter Tuchman. If you ever see those guys on CNBC, it was the five of us were talking about inflation. And it was right before they called the next one after the 10%. And Sarge says, this is the peak, right? And Sarge is super smart. And he goes, this is the peak. We're coming down. And he's like, this is it. And then it started coming down. And I started kind of sharing a theory I had about inflation was going to go up and come down and have some residual waves for a little bit. So that like summertime this year, we would be experiencing a second smaller wave of inflation. And chatted for a little bit about it, but it was like 2 cycles ahead. So it didn't really get much, you know, it was like something that's, you know, a year out, you know, inflation's coming down. It's probably going to come down for the rest of the year. Fed's going to raise rates, start to pull back by the end of the year. And if you go to my Twitter feed, you'll see that I was tweeting all this stuff like play by play before it happened. They're all there. And actually, I know you can like mark tweets now and pin them. So I'm going to kind of like, or save them in a library. I'm going to save all my calls in a library because last December, I'm talking about wave 2 of inflation. And I actually posted, I said that in January, that actually when we had 50 basis points, I said in December, we'd have 25, January, we'd have 20, or December, we had 50, January, 25, February, 25, March, 0, April, 0, May, 0, June, 0. Like we're going to stop raising rates as early as this month. And I said that last year. Fed fund futures still pricing in 25 basis point. Okay, that's fine. But where we are sitting right now is it's very possible the Fed slows down because the real bear part of the market is actually quantitative tightening. And as the Fed's size of their balance sheet gets smaller and smaller and the liquidity is fully drawn from the market, right? When they're not fully drawn, but drawn to the level where they're done, the balance sheet roll-offs stop, we'll be at a place where the market's going to be basically responding to the actual effects. We haven't seen QT. I haven't seen it in my lifetime as a trader. So I have no idea how the market's going to trade or respond in general, but I just know that QE is a period of explosion. We had 12 years of rallying, didn't we, after the last recession? So obviously QT, if QE caused an explosion, QT is probably going to prevent one. So I'm going to be like cautious going through the summer because, well, none of us have traded QT. Even your expert traders, many of them out there, have never seen an event or a period of QT before. So while inflation, yes, it's causing turbulence today, the real elephant in the room is quantitative tightening. And, we heard about it at the end of 2021. Wall Street started responding, but it takes a while for that Fed balance sheet to roll off all those assets, and now you're dealing with it, right? They hold everything from Treasury, which is debt of the United States, right? You buy debt, they get a return. You print money to buy it. Buy those notes. They hold mortgage-backed securities, right? They hold all kind of stuff to float certain things or stabilize certain things. And without that, you might see some volatility in some of those environments, right? So we're dealing with, that's actually the mechanism. Now, on the surface, people respond to inflation numbers because they believe that'll drive the hand of the Fed. If inflation gets worse, the Fed's going to raise rates. But I'm going to tell you, the Fed is not going to raise rates faster. The Fed's not going to do anything to rates. Right now, leading into QT, we do not understand or know how the stock market or Wall Street will respond to that, or how the economy will respond to that. There's no way in hell that Powell, if he hasn't lost all his marbles, will raise rates aggressively into the summer. It makes zero sense to apply two negative catalysts to deflate the inflationary world when all they need to do is stop providing liquidity to the market and let Wall Street destabilize a little bit, fire 5 and 10% of the workers, wages come down, everything stabilizes, people are happy. And you're going to get a little bit of a resurgence of a secondary wave of inflation, which is what we're experiencing now. And then they continue to be less hawkish. And then we ride through QT, and as long as we make it through the summer and the market is flat, then the Fed can raise rates as fast as they want, and Wall Street won't care, and we'll rally while we get rate hikes. We've had it happen in the 80s, and it's going to happen again if Powell can drive that boat perfectly. So there's no way in hell we're going to see increased rates faster until quarter 3. So we're going to hit 25 and 0 and 0 and 0 and 0. How do I know that? Well, let's build it. Let's build the case really quick. And I'm going to go through it quick because fundamentals make me want to go back to bed. But let's just go through it because you have to learn a little bit of something today, right? What are you doing in the market? Oh, no, it's irrational. I'm not doing anything. Well, hey, how about that? Market's not going anywhere. Wouldn't you like to wake up and know that and do nothing and just chill? Jacob Celsius chilling. Okay. Market responded today to some Fed comments, but also, if you see right on the dot, we moved exactly at the moment of 8:30 in the morning. Core PPI came through, continuing jobless claims came through, and all this stuff. Now, I'm going to walk you through a quickie little tutorial and some cool supply and demand mechanics on how you can predict the inflation numbers months before they can happen, before they come out. You want to do it? You want to learn a trick? Because it's all about tricks. There's 3 things that really matter. Sure, yeah, you can listen to the number on the surface and be like, oh, inflation's up and down. How would you like to forecast inflation a couple months out? Would it be a better use of our time? All right, let's not talk about the numbers. Let's predict the next ones. I like that concept. You have 3 things we look at to predict inflation. Something called JOLTS. You have first time unemployment. And you have continuing unemployment. These numbers come out right here every Thursday. Every Thursday. And then this is once a month. So this is monthly. If you want to take a little lesson here. This is Thursday, 8:30, Thursday. You guys want to be fundamental gurus without having to really read a textbook? You want to learn it from the streets like a madman or a madwoman? You're getting really confused and you're asking yourself questions. I tend to like to talk to myself. I'm the type of person that tapes newspaper clippings to the wall and connects them with strings. Like Beautiful Mind, just kind of talk to invisible objects. Do you think we're going to test the October lows? No, I do not. Market's too liquid to crash right now. Liquidity is increasing and there's more market participants in the COT. Will show you that. It's too liquid to crash. So it's going to take a mechanism to crash the market that's a shock and surprise. The only shock and surprise that's going to come would be an increased speed of rate hikes. If we go back to 5, 1, 2 now before QT comes up, then or QT is fully realized, then that'll shock the market. Number 2 would be earnings. We'd have to trade it lower naturally through the effects of how companies are responding to the state of the economy, which is a slower burn, and we already went through big earnings, so we got another quarter of just a slow float down. If the market's bearish, which I tweeted a month ago, a little bit over a month ago, the bear market is back. Do you remember my tweet? And people were like, whoa, Matt, you were the guy that said the market bottomed in October. And I said, yep, the market's now topped. And we've been trading down ever since. And this is why. And I'm going to tell you how I called that and why we're trading down. Now, what's going to happen, I feel like, here, let me draw the last 3 years of the stock market, right? It's doing this, wave 1. Wave 2 bounced in, let's say July, August, September. And we went like this, like that. Back in the 3rd week of October, I said we're bottom for the year and rallying through January, genuine buyers. So we did that and that and that. And now we are doing that. What are we going to do? We are going to literally stay in this range and probably do that. Maybe if a couple bad catalysts kick us out for a wave or two down, maybe lower. No way we fall there unless we have an illiquid market. There's just enough. There's so many buyers here, and the commitment of traders will show you that. There's enough people buying that the market's liquid enough. People are returning to the stock market. Cash is flooding into equities and futures and ETFs. So we're likely doing this until next earnings, where we'll probably dip down a little bit. We're not leaving this range until the summer. If the market crashes, it's going to be because it has to work its way lower, and companies surprised with layoffs and layoffs and layoffs. And it just doesn't look like that's happening. And I'm going to explain why I don't think that's going to happen as well with the same argument. And it's a great argument to have. If you want to learn something, stick around, I promise. You might be like, what's the play of the day today? What's this guy doing? Let me follow his trades. This is talking about fundamentals. I'm talking about, in 5 minutes, I'm going to show you how to predict inflation numbers months in advance. This is the most important use of our time today. Not willing away my trading account, about 40% on the challenge account without a losing day. Because when I wake up and it's irrational, I don't force myself to gamble. I force myself to think or go back to bed. Does that answer your question, Joseph? No. So this is how you can predict inflation. Ready? This is a cool tool. You can't always predict inflation this way, but you can predict the type of inflation we have this way. Jay Powell always talks about the labor market. So the labor market, right? COVID did this, market crashes, everyone loses their jobs. So labor is zero. There's no laborers. There's no materials, nothing. So the cost of stuff went up, and everyone turned their businesses back on and said, all right, come back to work. But it's like, simple as this, right? The one Maverick truck driver that was like, oh yeah, dude, I'm going back to work tomorrow. They finally let me drive again. I'm going to go pick up some goods, ship them somewhere, make some money. And he goes to his truck and says, oh man, shoot, I got a flat tire. Well, I guess I can't drive. Well, he made a deal, right, with somebody that's like, I'm the only truck driver that's standing here. You have 10, you need 10, and I'm the only one. You're going to pay me triple, or I'm going to go down the road. And they're, no, wait. Okay, we'll pay you triple. Come work for us. We're desperate. We need to ship our stuff. And he's like, cool, you're going to pay me 3 times as much. And that's what happened. Literally exactly what happened. Wage inflation. There was an oversupply of jobs. That's where supply of jobs. That's that report that comes out. And a lack of workers, and people getting fired and filing unemployment the first week are showing available workers, and people like available workers that just lost their jobs, because that's when you'll file, or continuing unemployment, or people that are without a job and can't get into the jobs that are opening. This is job openings. So this is a dynamic of how many jobs are available. The people that just got fired and people that already were fired, they can't get the job. And this dynamic is how you predict inflation. Well, wage inflation comes from a surge of jobs as whoever Trump is president at the time opens everything back up, and then, well, people trickle in because they're still afraid of getting sick, and for good reason. I had the first wave of COVID. I had the bad COVID. That's nasty. You didn't want that. You didn't want COVID alpha or whatever it was. I was streaming live when people still thought it wasn't even a real thing, and I'm like, guys, I got it. It sucks. And so, yeah, if I were leaving to go to work, I wouldn't be going. I was out for like 6 weeks. I didn't leave the house. It was that bad. And so nobody was going back to work except for that one Maverick who was like, I'm immune, baby. Let's go. And they went to work, and they could claim as much money as they want because the company is desperate to get their product back out, right? So wage inflation happened. Easy as that. And on top of that, you know, that backing up, right? As people are trickling back in, maybe the one logger goes back to work, picks up a saw, starts cutting some logs. And now logs are stacking up as he's just doing his job. And there's not people picking them up and taking them places, right? And it's the only company in town that had the logger come back. So now that shortage of materials has everybody needing to build houses, and the lumber boss, I'm going to put his boss, I'm going to put a top hat on him because he's and a monocle. He's a baron of industry, and he says, aha, I can make a ton of money. I'm the only person with logs. You and me, my friend, keep sawing. We're going to be rich because everybody wants our logs. And so the price of raw materials goes up because the monopoly man right here wants to raise prices because he can, because everyone needs lumber. But he also needs this guy to ship the logs to these people. And the guy at the truck is like, well, you know, hey bro, like, okay, but you know, but like I have a busted tire and I took it to the shop, but they're out of tires and they're also out of workers. So we're waiting, and they wait and wait, and worker goes back and he goes, oh yeah, we're out of tires. They're on back order. Oh, okay. Well, why? Well, the rubber plant, right? Polybutadiene. They need some raw materials. They couldn't make it because the refinery's down. Why is the refinery down? Well, they had something and they had something. And it's just backing up, right? Or maybe he needs a tire and this guy's like, yeah, well, the tire needs to come on another truck. We get a shipment of tires every week. But as you know, all the truck drivers are not shipping stuff because, well, it's COVID, right? So this truck is waiting on another truck that has spare tires on it. And maybe that truck can't come because it doesn't have gas. And it doesn't have gas because, well, the guy that drove the boat from one side of the world to the other, bring the oil to the refinery to make the gas, boat couldn't come. Maybe the boat couldn't come because they needed some spare parts that we need to ship to them on a truck that has a flat tire. So we're all stuck at this point. Everyone needs something that needs to be shipped from someone else, but they're bottlenecked by that someone else, which really means they bottlenecked themselves in a huge circle. Boy, that's a big spaghetti bowl to untangle, right? So that's where we were for a long time. And the only way, and we called it in math and physics, called a standing wave, which is once the effect is over, you shock the market and goes away. It's like a car wreck. After the car wreck happens and the cars are gone, there's still a slow spot in the road because it's the net sum of people accelerating minus the net sum of people decelerating. Still causes a little bit of friction even though there's no real congestion. It's induced after the fact, and that's what we experience, and that's exactly what we're dealing with. So, hold on. So right now we're just experiencing that residual effect. And so it takes a long time. The only way that heals itself is just people slowly start untangling that web. Nothing the Fed can do can speed that labor. So whatever they did was just, we had to wait it out. And as we waited it out, as enough people went back to work, as supplies hit the market, prices came down. So this type of inflation, because of shortages, is called cost push inflation. And the Fed has no handle to control that. But you can predict the most important part of that, which is the wage part of it, with these three reports. And that's what came out today. Two of them. So in effect, what's really causing the second wave of inflation, I'll just kind of tell you what's pretty neat, is that when the Fed raises rates, it scares Wall Street to start laying off these inefficient people, right? So everybody post-COVID was working from home and likely not working for a paycheck that was double what it was before they were actually really working in an office. So this is a huge inefficiency thing, and companies started laying those folks off, right? Your Netflix from home. I always say Netflix from home is your job. What do you really do? Oh, you know, I'm a doctor. Well, what do you do? Well, I chime in occasionally on telemed and do whatever, but I really don't do much, right? And then you're like, well, and then they're also getting paid more for it. Well, what a weird state of the world. Well, of course, the inflation went way up, right? Productivity is down. People are doing very little and getting paid for jobs, and companies realizing they didn't need all those workers, they laid them off. So the JOLTS represents the number of jobs available versus the number of jobs available that are open that you're trying to actively fill. So if you had 3 accountants on a project, you didn't realize till COVID and you laid them all off and sent them all home at Zoom, and you realized you didn't need 3 of them, you only need 1 of them. You laid off 2 of them, right? So the jolts went down. You had 3 jobs and you just closed 2 of the jobs. You didn't just lay people off. You sent 2 people to unemployment and you actually killed the jobs. So jolts comes down in the scenario. It's the number of jobs open that you want to fill in 30 window. You had 3 accountants, right? And you go, well, we don't need these positions. We're going to close them off and no longer fill them. So I sent 2 workers, A and B, to unemployment. And when you get laid off from your job, usually on the way home is when you start calling or looking up how you're going to get unemployment so you can get some money from the government. Like immediately. So the first time unemployment report are people that literally just got laid off and they're like, oh crap, I need money. That's the first place you go. Immediately start cashing in that advantage and right that you have to get unemployment. So these are people that just got laid off. The 2 accountants, boom. First time unemployment. So that number went up by 2. That number went down by 2. Pretty simple to see that. So when jolts go down, unemployment goes up. It means that they're killing the jobs and people don't have jobs. What this does is the supply of workers goes up, the supply of jobs goes down. So supply and demand means wages go way down. Congratulations. If you lay off enough people and jolts come down enough, wages come down, and therefore inflation's coming down. And we saw that for a while. And you could predict that before it peaked and turned around. I built that case on that podcast with the street and it was right. And that's exactly what we saw. You can go through and look at all the numbers, but let's just see. Let me pull up jolts real quick. And then that's it. And this is all we're going to talk about. We'll stop doing fundamentals. I'm bored. I'm putting myself to sleep. But this is a great thing to learn. I promise. So right about the time the CPI peaked is right about the time companies started laying off that 3rd accountant and that 6th procurement manager and that, 7th IT guy and whatever that they didn't need. They literally started closing the jobs. And as jolts have a requirement, it's the job could be filled within a month. So the jolts, the Labor and Statistics Bureau measures just how many jobs are available. And if this number is coming down, typically it's because they're removing the job. Easy to see that. Cool. So that's when inflation started coming down directly. As this number started peaking out and turning down, you're like, okay, that's good. And then the next step is first time unemployments, and that comes out every week. And I love looking at these numbers. Initial jobless claims. These are folks that just got the axe and they're like, oh crap, I need money. Let's go file. Because you don't normally, oh, I got laid off. No, it's okay. I'll just file for unemployment in like a couple weeks. I'm in no hurry. You're in a hurry, especially when you bought a house twice the price, right? So you need your money quick. And so around that time, you start to see that, unemployment's actually, let's go way back here. You see that unemployment's coming in waves, right? You have some cyclical behaviors. Unemployment's going up. These are the small amount of layoffs we experienced as people are just getting laid off. Jobs are getting clipped or companies were removing workers. You have that. First time unemployment are people that just got laid off. So, we're experiencing waves of layoffs little by little by little, but not like COVID level where it just basically like everyone gets laid off at once. So it's not really that drastic. And Jay Powell's whole idea was let's scare the market enough just to lay off little batches of people at times, right? Let's just tease the market and dangle the rate hike carrot in front of them so that companies little by little every quarter pretty much experience layoffs. Companies are going to lay off people, monitor their earnings. Lay off some more, monitor their earnings. Lay off some more, monitor their earnings. Exactly what you see. This is moving in quarterly cycles. 3 a year. Pretty cool. Almost 4 a year. We're going through the 4th one right now. That's exactly what you happen. Companies don't want to lay anybody off, but they're going to lay off that person who they realize isn't really doing much for a huge salary. Let them go. So when that number goes up, wages come down. If the jobs stay the same or even come down, which they did, which means wages come down double fast. So if the number of jobs are reduced, the number of workers are increased, that's double wage deflation. Great. And the CPI number peaked and then started coming down, but now it's starting to go back up. Let's talk about it. At first, everybody, we're dealing with a weird experience right now, and we're gonna just kind of talk about it super quick. Right now, we have an interesting phenomenon where the market's stabilized and jolts have gone up, and first-time unemployment's gone up, and continual unemployment is going up. They're all three going up right now, and that's what we're dealing with. Different environment. So, in a storybook sense, what you're dealing with is something that's really weird. Companies are going, okay, they're creating new jobs, okay, right? The two that got fired, the company's like, okay, I need two more programmers. Yet, in general, more people are getting laid off. You had A and B and now C and D. You have more people getting laid off while more jobs are being created. That makes zero sense, but that's what you're seeing. And then you have the last part is continual unemployment. People that have been laid off can't get the jobs that are getting open either. So what's going on? It's a very weird situation. That's exactly, all three numbers are going up. And so the CPI is starting to do that. And that's because of this. So this is an efficiency problem. Companies are like, okay, we need jobs, and we laid somebody off, but the job is still available, which means we want somebody in. So now companies didn't just get rid of the jobs. Companies are now starting to expand and grow. How about that? Which is great. But the companies aren't satisfied with the quality of labor that exists at the price. I'll put $2 signs because these guys went double the salary because, well, they were the smart ones that went and bought a $400,000 house for $900,000 during COVID, because boy, oh boy, what goes up never comes down, and let's rush and buy a house because we're not smart. Well, clearly they're not that smart, and they want a high salary, and the company's like, yeah, no thanks. We already fired you before. We're opening the jobs, and we're going to just let people come in there and take a lower salary. So that's a giant game of chicken between the available jobs and the available workers. They want too much money to cover the expensive bills of stuff they bought in COVID, and they want to pay a whole lot less because they don't want to go back to the problem they were in before, paying high wages and making nothing on margins for selling their product. It's a big game of chicken where the company is kind of sitting there wanting more efficient workers for less money, and the workers want more money to still sit at home and do nothing. So now we're stuck. And because of that, who normally wins this fight? The workers, always, in every case, always win that fight. Because the companies can't not make stuff or else everyone loses, right? That if the company can't get the job done, then that effect trickles all the way back up to the CEO, and everybody doesn't make money. And the company stock tanks and the shareholders lose money. So eventually, if you ever see any historic, even like the early union days, right? In the Industrial Revolution, the workers always win. That's what strikes are, right? Ultimately, you push hard enough, the workers will win. So the high wages ultimately will win this game of chicken, and that's what you're seeing right now. Companies are like, fine, let's take the hit again. We got to get somebody in here, and that's what you're seeing. And that's wave inflation number 2, and we predicted that that would happen, and that's happening right now. It's a standstill. Companies are like, okay, we can expand. How do I know? Well, I'm expanding. I run a company. I've hired so many people this last year, and I can't find developers fast enough. You know what they're doing? They're asking for ridiculous salaries from me because they can, because they're in high demand. And it's an inflationary world. They need more money. And I'm the business owner that needs the worker. And boy, I'd love to not pay more money. They love to ask for more money. And guess who wins? They win every time. Because I need them, right? And so that's from my perspective, right? And that's what we're experiencing, a slight secondary wave inflation. And that's problem number 1. And problem number 2 is why the stock market responds to that, because you know the company either A, is telling you we have jobs, we don't like the labor pool. We already fired this person, we want to put somebody back in. So when you want a more efficient person, they're going to want a slightly bigger salary even without inflation. So the company's investing more into a worker now to get more out of them later. So the bottom line comes down a little bit because the company's gonna, if you want a more efficient person, you're gonna pay them 5 or 10% more. Wall Street perceives that as initially bearish. So if they're increasing jobs and don't like the labor, then they got to pay more for some labor, whether it's because of inflation or they want a more efficient worker. They're still investing more on the front end to get the gains on the back end. And that's exactly why we're experiencing a non-bearish run and all these responses to these jobless claims numbers, because smart people in the room understand that this is how you predict inflation, through this mechanic. Good tip. You need developers, Matt? Not anymore. We've hit a steady state with the developers, but yeah. So now you're seeing what we deal with, right? When you're talking about how to trade and be a trader. See, I just back pocketed a number in my head. We have two. That's one mechanic, and number two is you have this weird thing called sector. I'm calling it like sector wage inflation. Is that this is a bulk number of all types of jobs. So certain people are getting laid off and certain people can't get their jobs back, which is the second wave. And there's jobs being created. Well, it's not like the jobs being created is like one in each sector. There's certain sectors that can't hire people fast enough. And there's certain sectors that can't fire people fast enough. If you actually subdivide those numbers, you'll see it's very tilted more. It's not a problem that's existing everywhere. Like oil and gas are literally bribing people to stay. They don't want to lose people. It's hard to find quality oil and gas workers right now. Anything that deals in commodities or materials or staples or healthcare cannot find good labor fast enough. They're willing to pay a heavier price. And so there you go. Certain sectors are up. Other things like tech, we're seeing massive layoffs in the tech industry and things like that. Can't fire people fast enough. So it's like certain sectors are like wages are plunging in some sectors and wages are inflating in some sectors, which again is creating a reverse effect to wanting inflation to come down. That's creating a scenario where inflation is kind of hitting spot sectors. And you can see that by looking at the spider ETFs. Some ETFs are doing very well. Some sectors are doing very well. Some sectors are collapsing. And so some sectors are more resilient to wage inflation. Some aren't. In oil and gas, anything deals in commodities, because commodities, if you think of as a currency, you're kind of battling inflation by just raising the price of your staple or your commodity people want, like energy and food. So if like I need to pay more workers, then I just raise the price of gasoline, or I trade the price of gasoline up, right? I raise the, people have to have it, and then I'll just raise the price to adjust. So those type of environments don't really care too much about cost push inflation, because they're basically selling currency. Oil is currency, gas is currency, right? Energy and food, if you start thinking of them as currencies in some countries, that's your main export, it's essentially your currency, right? And so you have the ability to be resilient to wage inflation because, well, you set the price of your currency by setting your selling price. And so like financials look like this. If I put the XLE right next to it, you'll see like, right, some sectors are booming, can't hire people fast enough, and don't care how much it costs, right? That's why it looks like that. So anything dealing with energy, food, staples is like something you need. See, consumer staples, like you need food. Consumer discretionary is like computers, iPhones, TVs, things you just want to buy if you have extra money, but you don't need. So you can see very clearly that certain sectors are more resilient than others. So you're seeing inflation in certain areas where people are getting raises and raises and raises to keep them there. And you're seeing other sectors where people are getting fired every other week. And that's where we are. And so welcome to inflation round 2. It's bad enough that any increase in first-time unemployment or continuing unemployment with jolts coming down is enough to do this to the market. And if you wanted to just kind of get ahead of everything, it's not a good sign. I'm waiting for 410.5 to decide if I want to short this or not. I don't know. Still waiting for my entry point. I know it's boring, but we wait here. And pretty cool. So initial jobless claims. Let's compare. And remember, anytime you go irrational or you just move irrational on an event, it's a catalyst. The market got shocked. Something they didn't want to see. And here's the shock, right? The expectation was 200K. we came in under. Compared to the rest of the year, though, we are still going up. First time unemployment. Now, 194 beats the 200 expectation. Okay. But still, after the adjusted 195, we're at 194. You're seeing first time unemployment still, and this is a number of people who filed, right? So you're not seeing a drastic increase or decrease from the week. But in general, when you saw fewer and fewer and fewer people filing down to 180, and now we're at 190 and 190 again, there's your hook. As more people are filing unemployment, more people are getting laid off while more jobs are opening up. We put the JOLTS next to it. Right. So there you go. Wage inflation is back. So that's exactly what you're seeing. And that's why we crashed for this morning. Not boring, patient. Yeah, just being patient. It's a cool thing. So jobs are opening up. And the next JOLTS will come out. It's one of my favorite reports. And people didn't know how important that was March the 8th. But did you learn something today, at least in the stream? You learned something? JOLTS going up. While people are getting fired, companies are now being pickier and playing chicken with the workers. Workers want more, companies want to pay less. And certain sectors are stronger than others. And I just showed it all to you. So you're experiencing exactly that. As Hyper Alpha is saying, new unemployment claims much more important than continuous jobless claims. As a state of who just got laid off, right? People are getting laid off still while jobs are opening up. So it means both things together. So certain sectors are like, we're expanding, and other sectors are like, we're removing jobs. And then of course, in general, you can just say that as a whole, you can also perceive that as companies are getting rid of inefficient labor and want to replace it with efficient labor. And the side of this, both of those effects are adding to that. And so the continuing jobless claims, how that is important, are people that got laid off 2 weeks ago, right? It's the available workers who still can't get their job back. And if there's jobs opening up and new jobs created, and those people can't get the jobs, it's kind of like that person that's been on Tinder for 2 years and can't get a date. They're toxic. They want too much for their labor. They're not good enough for what they want. They're like, they've been sitting there trying to get a date or trying to get a job and nobody's calling them. They're not good enough for the jobs that are opening up. Exactly what that means. Do y'all get that? So continuing jobless claims is exactly what that's saying. Is if you have the JOLTS going up, it means there are jobs available. And the initial are people that just got laid off. So they're not transitioning the next day to a new job. This is going to take some time for them to, put out some resumes and find a new job. But you're dealing with the continuous claims, and the continuous claims are showing the quality of the available labor. The people that have been sitting there, they can't get a job. And the continuing jobless claims have been going up and up and up and up. So essentially, right, the jig is up. You've been working at your job for 10 years. They finally found out you don't do anything and they fired you, and they're not writing you a letter of recommendation. They realized you didn't do anything when they sent you home during COVID and you chimed in once a month to a Zoom call, and they realized that they didn't need to pay you. And so all of those people, a lot of people were in that situation. A lot of y'all might have been in that situation where you were like, oh crap, I haven't really been doing anything for a couple of years and I've been getting paid. And shit, after COVID, they figured that out and I got laid off. Now I'm trying to get a job and they're not out there vouching for me. Crap, I'm stuck without a job. And I'm stuck in a high house payment, and I can't ask for a lower salary or I'll lose my house. So this is the quality of very, very, very inefficient. This is your 10% of the workforce that got laid off and then are toxic, can't get a job back. Or because they either want too much or they just sucked. And they're not getting vouched for. And that is what you're seeing. And those people are stuck. And they've been stuck since September. Or they're in a sector on the other side of the coin. Maybe they're just not terrible laborers, but they're stuck in a sector where there's just so many workers, right? That they just not have jobs in that sector. That's a mix there. And that is going up a second time. And that is the fear of inflation. So people that were laid off can't get their job. People are still getting laid off and jobs are opening up. And that is inflation wave number 2. Oh, should I short? What do we think? Should I play small and short off of MHP? Ooh. Rates are going to be raised to 0%. Why? Because the rates have very little to do with controlling this type of inflation. Rates destimulate the credit market. When you raise interest rates, you destimulate banks from lending money, issuing new credit, things like that. And that stops a different kind of inflation. The inflation that creates bubbles. Like if there's a bubble in the housing market and people just are making money because productivity is going up, right? And then all of a sudden banks are starting to lend faster than productivity. And then that additional money, additional spending raises the price of everything that people buy. So people borrow more, prices go up. People borrow more, prices go up. And the prices go up and up and up. And then eventually the banks exhaust all the AAA borrowers, run out of desire to lend out credit. And then all of a sudden the buying spree dries up and the inventory backs up of the houses and they can start lowering prices, which devalue the assets of the original people that started buying high, and then all of a sudden it becomes a seller's market, and then they sell, and then it crashes. This is your traditional short-term credit cycle, and that's what normally happens. And the Fed, as like lending starts to go up, if they start raising rates, it kind of slows down lending so that the banks don't lend out as fast to create bubbles. So they control hypereconomic bullish activity by raising rates. It happens all the time. U.S. credit default swap just hit highs on the 1 year, higher than '08. Well, you know, people are, well, the Fed's rolling off such a massive amount of mortgage-backed securities. I mean, I'm sure the credit default swap bet is back on, right? I mean, the Fed is a very large holders of MBS, so I mean, I wouldn't be surprised that people are spending a hell of a lot of money on swaps. I don't see any. The unemployment situation is what's getting scary, right? The continuous jobless claims are doing that. So it's kind of like wages need to come down, and that's a slow process. I'm going to predict that the CPI is going to do this. Over the course of a year. It's not going to go out of hand. Eventually, these people are going to default, and that's what's going to happen. That's what that bet is on. Continuous jobless claims. You bought your, here we go, ready? You and your partner heard in a frenzy, your buddies had their house for $250,000 and then they sold it for $400,000, and then now houses are going up. And you see this $300,000 house that's normally like that going up to $350,000 and then $375,000, and you're like, we need to get in because we need to get a house or else we'll never get one. Oh, okay, well, it costs more. That's okay. You know, COVID happened. I didn't get laid off. Let's just pay more anyways. Okay, cool. So they get in this job. They get in this house that's more expensive. And then it goes up and goes up and goes up. And everybody keeps buying houses more expensive. And then all of a sudden, companies start laying off 10% of the workforce. And that person lost their job. So now that person continuously not able to get a job back has a higher probability of defaulting at 375 on a house that's now likely going to be devaluing on top of that. So the problem is people are betting against the housing market again because of the continuous jobless claims. I don't know if I want to short though. That MHP is really strong at 40. So I'm deciding not to short here because that's way above zero. So I'm not going to take the bet against the market today. What I do think is that we do trade up against the DD band, and with the regular resilience being negative, I think a short trade from here to here would be appropriate there to there. So I'm going to wait and take a 411 short off the middle, which will be shorting a CD band. I'll take like maybe 2 contracts from here to here. Multi-res is too positive to tell me that I want this to reject. Now, again, irrational, so I can't assume that it's leading, but 40 is very strong, so even in irrational, it's strong enough to break, so I'm not going to short against it. How does higher for longer affect the United States government interest expense? Tax receipts are failing. What's the impact of the Treasury? Oh, that goes above my pay grade. I have to think about that for a little bit. That's a question for like markets and mayhem. Treasury stuff. That's my weak spot. I probably should start looking deeper into that. I'm not at all a fundamental expert, by all means. So now we're sitting in an area where people are betting against the housing market again because they're betting against waves of unemployment, which is It's being seen right now. But the question you have as a trader is that unemployment? Because companies are crashing and bubbles are popping and they're getting laid off in massive waves? Or is that unemployment just kind of like a call for efficiency? Yes, we're going to have defaults. Yes, those people are not going to pay their houses. Yes, the housing market's going to come down. Is it going to collapse? No. Is it going to crash? It's not possible at this point. Right now, maybe 5-10% of the workforce is losing their jobs in certain companies. And the worst of the recession, or the worst of the data, unless some companies just start toppling over and unemployment start to skyrocket, that's really the bet. And earnings are coming in kind of mixed bag, and some of them are coming in good. So companies are weathering the storm very well, and automation and other things and efficiencies going up. So I don't really think we're going to have a mortgage crisis like we did before, but we are going to have a bunch of people squeezed pretty hard because they were dummies. And it's not like in 2005 when people were buying houses without even submitting a credit application. There is a funny story that someone's dog got a mortgage. Literally their dog. They put their dog's name on a piece of paper and they got a loan. No social security number, nothing. That's the story I love to tell. So that pure stupidity crashed the market. Absolutely, right? You're probably going to see how many of us went and bought a house during COVID at ridiculous prices. I would say less than 5% of people in this stream bought a house in the last 2 years. I would say during 2005, I feel like everybody was getting a new house. You couldn't get in. Like, there was so much money and so much everything. And through 2005, 2009, right? And it took a long time for the defaults to pile up because people were getting these adjustable rate mortgages. They were getting teased into home loans that were easy to get. This environment, people are getting teased into easy to get home loans. It's hard to get that home loan for that very expensive house. Banks are being very picky post-COVID. They weren't lending out money to just anybody that submitted a piece of paper. They were lending to like AAA borrowers only. So the people that are at risk are the people that are the best, most efficient workers getting paid the most with the best credit scores right now. It's not a bunch of B tier and C tier tranches that are about to collapse, right? Even if you and your spouse had a job and you had your income, you still were getting denied loans post-COVID, and you had all things looking great on paper. Banks are being picky, and they weren't giving out loans that easily, right? Your house in Denver tripled in 6 years. Super nuts, bro. You should sell it and take all your money and go long on Tesla calls. I'm just saying. Not investment advice, though. Kidding, though. That's a great increase. Tripled? Jesus. In Denver. The housing market in Denver has gone way up, huh? Yeah, your family's from there. Ooh. You sold it for double? That's nice. Oh, so you found a buyer in the middle. That's cool to see. Should I short against half gap? What do you guys think? See, I told you I wasn't going to short against monthly because of monthly res. It's just too strong. Would have been nice to sell for triple, huh? Yeah. Alrighty. You'll see how I'm not in a hurry to do anything. Okay, today the S&P irrational below here. Y'all remember from the lesson. Monthly hedge pressure resilience. Yellow is a tiebreaker at yellow. Orange is tiebreaker at orange. So here, this is positive, and so I expect it to support. But the thing that I don't expect is for this to show stocks leading the market, right? We assume that stocks aren't leading. We assume the opposite, right? We normally assume in a rational market, stocks lead the index. But in irrational, which is below here, I assume that stocks don't lead the index. They could or they couldn't. You can't know, so I'm agnostic. So I get here and I look at this, and this is 40%. And this is, if this is hugging zero, I wouldn't take a bet. But this is way above zero. So even if it's lagging a little bit, it's so high that I'm not going to bet that it rejects. If this is hugging zero, I might want to make that bet, to bet that it's lagging a little bit. But it's so far above zero that I'm not going to bet against that. So now I'm taking the same stance of resilience is less than zero and it's possibly lagging. So half gap is the resistance to short from on the resilience number. And again, irrational. So pros only, I'll be trading a couple of short contracts, just a couple of micros, and I might kill the streak if I do it. My thought to decide, do I want to trade or not? I might just sit out today in general, just because no long to half gap. I only am short-minded when you open below monthly. That's my rule. I take the structure side every day. You'll learn this in the monthly hedge class. If you open below monthly hedge pressure, I'm looking for shorts all day long. If you open above monthly, I'm looking for longs. So because we open below, I'm not looking for longs monthly. That's the only time I make this assessment. I find every excuse to be a bull. So a break of hedge pressure, regular hedge pressure, I'm certainly bullish. That's the one side of the coin. So a squeeze on a bear long up, I'd definitely be bullish. But when you open down here, until there, I'm looking for shorts, and I'm only longing on the bull break. You know both my rules, Chase. Matt's rule is I find every excuse to be a bull. Well, when you open below monthly, I need to squeeze above regular hedge pressure for me to take the long side. When I open below here, I'm looking for the short setups, right? I take the structure bet every time. DD being... and also, we have a DD graph coming through with the new release, which is kind of cool. Actually, QQQ is at its DD limit right here. Roy, it means if a rational market, rational with an R, I assume that this is leading the index, and therefore I make that adjustment or the assessment. Right now, in an irrational market, which we trained on this week, you'll learn if you come to the classes below the screen band, irrational, I can't assume this is a leading indicator. And the fact that it's right at zero makes it even worse. I don't know if it's leading or lagging. I could tell that being 40, this is well above zero, that I'm comfortable enough betting that even if it was lagging a little bit, it's still far enough away from zero that it's clearly positive. This is at zero, and if it's leading, then okay, how, you know, it's, or if it's leading or lagging, I can't really tell if it's up or down because it's right at zero. So that's the hard part. When we get here, if this is slightly above zero or at zero, I'll probably short it. Normally, if it's rational, if this is above zero, I will bet that we break and go to the other side. But in an irrational market, I err to the side of caution. I don't use this like that particular pit, but in rational, yes, you're correct. Does MHP show on the app normally? Yeah, all the time. Make sure you have everything checked here. Click your defaults. And sometimes if you use browsers like Chrome, Chrome just sucks. If you're having problems, maybe. I use Edge for Rocket Scooter. I hate to say it. To me, Edge is the best browser to run Rocket Scooter in. I've tried all of them, and I've had zero problems ever with Edge. And I use Edge for nothing else but Rocket Scooter. Kind of. And Rocket Scooter related stuff. Because I use Firefox normally for everything else, but I use Edge like no extensions, no anything. Just have a clean browser experience, and I have all my fun integrations and extensions in Firefox. Yeah. Okay. Do I want a half gap short from here to here? Yeah, probably. I think I might take it just for fun. But we'll see. NQ right inside of DD bands right now. There's that yellow to blue. Ooh, that's a nice little pop. There's a DD band. 1, 2. That's it. It's small. So I watch one and trade the other. Let's put them both up here. It'd be funny to lose the streak on like a $7 loss, right? That's okay. I need to adjust the DD bands in real time. They are right here. Actually, sorry, right here. Now I want to see this dip or go down, just to look. Just demonstrating an irrational trade, pros only, right? We don't encourage irrational trading, but my normal position size is actually 1.5 minis for the size of the account. So the scalp from here to here, just to demonstrate this is right at 0 and irrational. To bet that we have a resistance from here to here, it's about a 1-to-1 trade. If I get 10 points on it, then I made $70. Hey, how about that, right? Better than nothing. So in this mode, let's take a look at both of the, let's do resilience. Put NASDAQ resilience at the bottom here. NASDAQ nice and purdy, right? Oh yeah. I know I'm being a little wuss, but let me just take the profit. All right, I'm done. Well, you know, I don't want to sit here and wait all day for this. I'm kind of bored. You want to go walk the cats? I kind of do. I'm going to go. We bought leashes for the cats. There you go. $30. Whatever. So, right. Small trade, small loss, irrational. You know, this is nice and strong. So, you know, NASDAQ is looking stronger today. And while this is a predictable short from here, I should have gone from here to here. I kind of still want to sit here all day and I don't want to kill the streak to make $8 or $40 or whatever. But you see what I'm doing, right? I took something predictable, made a couple bucks, called it a day. I sat there and waited all morning to do that to that. This is extremely predictable. Now with resilience pushing really positive on S&P, it's not hugging 0 enough to where I feel comfortable to hang in that short. Even if it does short, I don't care. But you see how if you wait for the right opportunity, you're just extremely picky. It pays off, right? Okay, we'll see y'all a little bit. Everybody, go to the Discord really quick. I got something for y'all. Something special. You're gonna love it. The extended trial starts now. We've discontinued our free trial. It's no longer applicable. If you had the free trial, any moment your platform access will be terminated and you can't have access to Discord anymore. Well, that's not a bad thing, but because we don't want you sitting there by yourself in a room when the parties move to the bigger room with more people and more DJs and better drinks. Extended trial is 3 months for $35 a month. You can cancel any time. It's $109 regularly $200 for $35. We want to have a huge inaugural party with everybody to come check it out. It's a new 6-week program. We want everybody to try it out. $35 a month. It's like once in a lifetime thing. We're never gonna do this again. We got like 500 something people join this thing. Join it. You will have a blast. You will learn so much. So come with us and check it out. Go to the Discord link below. Go there and send me a message. We'll start at noon, which is an hour and 20 minutes away. This is day 4. Day 4 is going to be awesome. So come, everybody come.